A nurse practitioner came to me last year with a problem. She'd switched from permanent hospital employment to locum tenens work, earned about the same gross income, and her tax bill jumped by $14,000. She thought she'd made a mistake. She hadn't. She just didn't understand how locum income gets taxed differently. Today, I'm breaking down exactly what changes when you go from W-2 to 1099 and how to keep more of what you earn. The biggest difference is self-employment tax. When you're a permanent employee, you pay 7.65% of your wages towards Social Security and Medicare. Your employer pays a matching 7.65%. You never see their portion. It's invisible. But as a locum tenens contractor, you pay both halves. That's 15.3% on your first $168,600 of net earnings for 2026. On $150,000 of net income, that's over $21,000 just in self-employment tax, before income tax even enters the picture. But here's where it gets interesting. Self-employed NPs get deductions that permanent employees can't touch. Since 2017, W-2 employees can't deduct unreimbursed job expenses on their federal return. But if you're 1099, you deduct travel to assignments, airfare, hotels, mileage at 67 cents per mile. You deduct licensing fees, DEA registration, CME courses, even your health insurance premiums. A locum NP might have $15,000 to $25,000 in legitimate business deductions. That directly reduces your taxable income. Then there's the qualified business income deduction. If your taxable income is under certain thresholds, $191,950 for single filers in 2026, you may deduct 20% of your net business income. On $150,000 of locum earnings, that's a $30,000 deduction. At a 24% tax bracket, you're saving over $7,000 in federal taxes. Permanent employees don't get this. It's exclusively for business owners and self-employed individuals. Retirement accounts are another major difference. Hospital employees typically get a 403B, maybe a 457B. You can defer $23,500 of your own money in 2026. As a self-employed locum, you can open a solo 401k and contribute that same $23,500 as an employee deferral, plus up to 25% of your net earnings as employer profit sharing. Total possible contribution, over $70,000. That's potentially $40,000 more in tax-deferred savings compared to a typical hospital plan. Here's a real comparison. Two NPs, both earning $175,000 gross. The permanent employee contributes to their 403B and HSA, takes the standard deduction, and pays about $37,500 in total federal taxes. The locum NP has $18,000 in business expenses, maxes out a solo 401k, gets the QBI deduction, and pays about $29,000 in total federal taxes. That's $8,500 less, even though they paid the full self-employment tax. The deduction's more than made up for it. But you have to avoid the traps. First, quarterly estimated taxes. The IRS wants payments 4 times a year. Miss them and you'll owe penalties even if you pay everything by April 15. Second, track every expense. That hotel receipt, that license renewal, untracked expenses are lost deductions. Third, set up your solo 401k by December 31st. You can fund it until your tax deadline, but the account must exist by year end. So which is better, locum or permanent? Financially, it depends on your specific numbers. Locum work can absolutely result in lower total taxes if you maximize deductions and retirement contributions. But it requires more planning, more record keeping, and usually professional help. If you're earning over $150,000 in 1099 income, working in multiple states, or just not sure if you're optimizing your situation, it's worth talking to a tax professional who understands healthcare clinicians. The enrolled agents and tax attorneys at Prac specialize in helping nurse practitioners and advanced practice clinicians with exactly these decisions. Visit nursepractax.com/consult to book a free strategy call and find out which approach saves you the most.